More clues out of the U.S. Federal Reserve on when it will raise the key interest rate, but still no definite answer. The central bank cited weakness in key economic indicators as reasons why it would approach the matter with caution. Song Ji-sun reports on the market impact.
As widely expected, the U.S. Federal Reserve opened the door for a possible rate hike sometime this year, removing the word patience from its policy statement. But Fed Chair Janet Yellen stressed the need for policymakers to consider the country's still fragile economic growth prospects.
Today's modification of our guidance should not be interpreted to mean that we have decided on the timing of that increase. In other words, just because we removed the word patient from the statement doesn't mean we're going to be impatient.
The U.S. Central Bank slashed both its growth outlook and inflation forecast for this year, saying inflation would move below its 2% target, largely due to falling energy prices and a decrease in spending. Yellen also noted that exports have weakened partly due to the strong dollar, but said that also reflects the strength of the U.S. economy. This hints that the Fed will not rush into a rate hike, as that will lead to a stronger dollar and dent its outbound shipments.
Because the Fed did what was expected, and at the same time, the markets are getting the message that, you know what, the Fed's not in a hurry to raise rates, and we're probably going to have these near zero interest rates for a few months longer than we thought.
Seoul Central Bank convened an emergency meeting Thursday morning to discuss the impact of the Fed's statement and prepare countermeasures. The market consensus is that the impact on Seoul will be limited, and fluctuations in the global financial market will be more contained, as the Fed stressed a more cautious approach in light of the impact of its stronger dollar. Song Ji-sun, Arirang News.